Good evening, everyone. I welcome you on behalf of Mehta and Mehta Insolvency and Restructuring LLP. I welcome you for today's webinar on the subject of valuation of financial asset. I have been given a pleasant task to introduce today's speaker, Mr. Akshat Jain. He is a chartered accountant, also registered valuer for securities and financial asset. He's a IIM graduate from Calcutta. He worked with the leading professional service firm like Deloitte and BMR Advisors. He has carried out carried out various assignments. He has a deep expertise and experience in advising clients across industries and segments. He provides end-to-end suites of services in financial advisory and business valuation of companies going through different stages of growth journey. I welcome you, sir.
Thank you, Himanshu, sir. Thank you. Thank you for that introduction.
Yeah. Our today's speaker is Mr. Devang Thakar. He is also partner of Mehta and Mehta Insolvency and Restructuring LLP. By profession, he is a fellow member of a company secretary. He has a bachelor degree in science, diploma in system management. He has done his masters in financial management. He is also independent director and insolvency professional, registered with IBBI, ICICI, IIB. He is a registered valuer, registered with IBBI and ICICI RVO. Devang Thakar brings his expertise of over 30 years in the area of finance and secretarial compliance. He has been visiting faculty for finance and business law with NMIMS, IES, IBS, Mumbai. He has previously worked with Messrs. Pidilite Industries Limited for 5 years, Messrs. M4 Industries Limited for 1 year before starting his own practice as a company secretary and financial professional. His knowledge expand his from corporate legal consultancy, financial planning, financial restructuring, financial and corporate legal compliance advisory services to companies. So with the diverse background and the experts panel we have, I'm sure that today's webinar will bring a lot of insight of the valuation of the financial assets. So over to you, Akshat ji.
Thank you, sir. No, sir. Thank you so much.
Yeah. So I welcome you on behalf of Mehta and Mehta, and I said that the floor is open to you.
Thank you, sir. Thank you so much. It's an honor to be here, and with such experienced professionals like yourself and Devang sir and all others. I think it's just a privilege to be here, and I think our community is growing and growing fast, and we are all learning. We are all a part of this journey, and to share knowledge is one of the primary things. So personally, want to thank Devang sir for giving me this opportunity, and he is an inspiration in his own. The way he has cleared his registered valuer exam at this age, I think it's commendable because people are giving up very fast. Whereas I have lived that journey until I actually met him. I never knew that sir is that experienced professional, but he's very young by his heart. Don't go by the looks. So I'm very happy to be here and to learn from all of you and give my 2 cents wherever I can. Thank you.
Yeah.
So, Sushant, you can start sharing.
Sushant, you can start.
Sure. All right. So, good evening, everyone. My name is Sushant Jadhav. I'll be presenting today's topic. We have a very interesting topic, which is valuation under Insolvency and Bankruptcy Code. So what we'll do with the introduction of this whole topic. accurate valuation of the assets, it's a very critical component in the insolvency profession, and it plays a very pivotal role in maximization of the value. For IP especially, assets valuation provides a very clear financial picture, aiding in informed decision making, transparent risk structuring, efficient resolution. It also directly influences the recovery strategy, helping to unlock the true potential of distressed assets and enabling a timely and equitable resolution. It also stands as a cornerstone in the successful execution of the insolvency proceedings, making it indispensable. The whole valuation profession has emerged as a cornerstone of financial growth and stability, gaining significant recognition both globally and in India. IBBI has taken innovative steps by categorizing asset valuation. This allows domain experts to deliver precise and reliable valuation, fostering confidence in financial assessments. Additionally, introduction of the registered valuer qualification has set new benchmarks for the profession, ensuring that not only well qualified and experienced professionals provide valuation services. Supported by registered value organization, the valuation profession in India is also now aligned with global best practices, contributing to enhanced transparency and trust. As the profession continues to gain momentum, more professionals and students are entering this dynamic field, ensuring that valuation remains a very vital pillar in India's financial and business landscape. So we'll start then after with the procedure to become registered valuers in India. There are few certain steps where we can just follow
Roshan,
in
you
order
want
to
to take
become
the
registered.
questions first, or how we do it? Or we'll ask for the questions or difficulties later on?
We like the viewers can pen down the questions and we can take it as and when the topic comes up or after the presentation, whatever suits the panelists.
Okay, fine. That's good.
Yeah, I think topic wise we can. Like for example, right now you're talking about procedure of registered valuer. If any of our members are interested or have some questions, we can keep having a 1 or 2 minute Q&A.
All right.
Mr. Pankaj has raised his hand. Okay, thank you, Shi.
Anyways, move forward. Sushant, I think.
All right. I'll start with the process to become registered valuer. Well, first, ascertain that they have a minimum qualification and relevant experience in the respective asset class to apply for membership. Then you need to apply for a membership with relevant documents with any of the registered valuer financial institutions. Attend 50 years mandatory classroom training program conducted by the RVF after paying the registration and training fees. Upon completion of your 50 hours of training, you have to pay your exam fees and appear for multiple choice type examination at the nearest BSc training center. IBBI is also tied up with Bombay Stock Exchange training centers pan India for the same. Once you clear your exams, you'll have to fill up a form A on the IBBI website and apply for registration of membership. Once the form is submitted, it will be verified by IBBI and then it will be approved. On approval, the person shall become registered valuer. Once a person becomes a registered valuer, he or she needs to attend a 6-hour classroom training on valuation code of conduct and ethics. This will make them eligible for getting certificate of practice. Once they receive certificate of practice, they can practice as a registered valuers. That sums up the procedure to become a registered valuer.
Do we have any questions from any of the attendees around this? Otherwise, Sushant, you can move forward.
All right. We'll move on to definitions. Mostly like the relevant definitions that will be of use. First is value in use. Value which a person would derive by usage of the asset in consideration. Second is value in exchange, value which person looks for when he or she exchanges the asset under consideration for monies or money's equivalent in terms of any other asset. This is the most common form of value referred to. It is also called as a price in common parlance. Value in store. When a particular asset is stored, it has a value which changes with the passage of time. For example, rice and wheat stored in warehouses will be valuable for a year from the date they are stored. Value in specific situations. The value of assets or items can change drastically based on the situations or circumstances. For example, value of vegetables post curfew or value of life-saving drugs during epidemics could have a completely different perception. Fair value. It's defined as a knowledgeable buyer and knowledgeable seller are willing to enter into a transaction. Intrinsic value is the value referred to as the true value of the asset, arrived at by factoring both tangible and intangible factors of the underlying. Investment value. Value is the purchase price of the investor. It is also referred to as the historical cost in accounting parlance. Synergistic value. Synergistic value is arrived at by using the combination of two assets. For example, bread and butter has a more combined value than standalone. It is also refers as a marriage value. Market value. It is a value at which the asset can be sold in the market at a present time. Legal value. Valuation is mostly done to arrive at a value tenable in the eyes of law. Most court cases in any legal proceeding, they would like to have an opinion on the valuer on the legal value of the asset or business in consideration. Accounting value or book value referred to as the carrying cost of the asset in the balance sheet. Typically, tangible non-current assets are subjected to depreciation and intangible non-current assets are subject to amortization. So the book value is arrived at by using cost-led depreciation slash amortization. Undervaluation. When the value of an asset arrived at is lower than the value at which it is currently reflected in the book, it refers to undervaluation. This may sometimes happen due to wear and tear, reduced in market value, technological obsolescence, and so on. Overvaluation. Overvaluation refers to a situation where the asset value is more than the book value. This would happen mostly to older assets which have the tendency to appreciate in value. Examples would include land and building. Financial asset. Financial asset is a non-physical asset whose value is derived from a contractual claim, such as bank deposits, bonds, and participations in company's share capital. Financial assets are usually more liquid than tangible assets, such as commodities or real estate. Now, a financial asset, according to international financial reporting standards, a financial asset can be cash or cash equivalent, equity instruments of another equity, contractual right to receive cash or other financial asset from any other entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. A contract that will or may be settled in the entity's own equity instruments and is either a non-derivative for which the entity is or may be obliged to receive a variable number of the entity's own equity instruments, or a derivative that will or may be settled under then by exchange of a fixed amount of cash or another financial asset for a fixed number of entities' own equity instruments. So
So
these
there
are
is one
certain.
question in the chat box. What is the difference between a fair value and legal value?
Akshay, would you like to take it?
All right, I'll take it. So fair value essentially is a value which, of course, is something which we determine by undertaking various methods. It could be a discounted cash flow. It could be basically it could be an income method, market multiple method, or a cost method. It depends on a certain situation, which one needs to determine that whether which method of valuation should be used. And then there are other sub methods which we need to evaluate whether to use a certain method or not. That's a fair value, which is generally, very well, I think, everyone has a fair idea of how to determine a fair value. Whereas what is a legal value is, when you determine a value under a certain legal regulation. Like for example, when you transfer shares from one shareholder to another shareholder, there is a legal framework which has already been provided under Section 56(2)(10) of the Income Tax Act. Read with Rule 11 UA of the Income Tax Rule 1962. It states that there is a certain way in which a value of a share needs to be calculated, and that becomes the legal value of that particular company and not the fair value. So that, so essentially, to sum it up, a legal value is a value which is being determined for the company, but it is binded by certain regulations and certain laws, whereas a fair market value is not essentially under a legal framework. It is a fair market value of a company, which is calculated based on various methods.
Legal value is for mostly non-quoted shares or private limited transfer shares or PEMA matters.
Correct. I hope that answers the question. Yes, great. We can move forward, John.
All right. So we'll take now premise of valuation. Valuation has a certain premise, or what we commonly call as a basic presumption. This enables a valuer to value the asset, and party getting the valuation done can reliably carry out the transaction on the value so derived by the valuer. To understand this better, we need to go back to the basic concepts and conventions of accounting. As for out in framework of IFRS, that's International Financial Reporting Standards, there are two ways: going concern and liquidation. To go in detail, first is going concern. One of the fundamental presumptions of bookkeeping is that a company or a specific legal entity is expected to continue its operations in the near future. This helps the valuer to derive value, factoring the usability of the asset in consideration. It also facilitates in arriving at a depreciation amortization of the asset over a period of its useful life, thereby ensuring accuracy of value year on year. Second is liquidation. This happens when the first presumption of going concern is violated. The moment going concern gets out of picture, all the assets are required to be valued at their disposal or resale value, and all the liabilities at their settlement value. This happens for many reasons: unviable future operations, accumulated losses, disinterest of owners, or changing regulations. Next, we move on to purpose of valuation. Now, three major purposes. One, we can start with sale of a business as a going concern. When business is sold, valuation helps set a base for negotiation, which often go beyond the basic calculations of asset minus liability. The valuer provides here an initial estimate. Though buyer and seller may have different valuations, the final price may lead to outcome like goodwill, bargain purchase, or no profit loss for the buyer. Second is business valuation for taxation. Valuation is sometimes needed for tax purpose, especially when disputes arise between businesses and tax authorities. The valuer here plays a very crucial role in resolving such disputes, requiring objective and detailed assessments. Third is business valuation for liquidation. Valuation is essential when closing a business, ensuring assets are realized, creditors are paid, and any remaining value is returned to the owners. This was a key factor behind India's valuation regulation reforms, highlighting the valuer's role in ensuring fairness. Next, we move on to the valuation process. The valuation process is very fundamental to valuer's effectiveness, with different approaches potentially leading to varied outcomes. The key steps in valuation process can include planning the assessment, gathering background information of the company, or documenting the purpose, establishing the premise, identifying the stakeholders who would be affected by this valuation, documenting findings. You can document the findings, whatever you come across throughout the process, arriving at a first stage valuation, evaluating the valuation, drafting the report, and then finally you finalize the report that you have drafted. Valuation report. Now, once you finalize the report, the valuation report is a very final product delivered by the valuer to the client, serving as a critical tool that communicates the valuation findings. A well-crafted valuation report not only conveys the result but also enhances the valuer's professional reputation and showcases the quality of work provided. We have a detailed breakdown for key consideration which can be used for drafting a professional valuation report. A valuer can start with his valuation report with title and executive summary. Then he can mention down the assumptions that he has taken while carrying out the valuation process. Then he can mention deliverables delivered through the report. Then the timelines, which includes valuation date, report generation, and submission date. Then he can mention milestones in case of long-term assignments. Approaches for valuation. There are three common valuation approach: market approach, income approach, and cost approach. Valuation method applied, key inputs used in the report, estimates, projections used in the report. Valuation approaches. The first approach that we'll go in detail is cost approach, that is asset based approach. The cost approach, also known as an asset based approach, values a business based on a fair market value or its net asset, which is the total value of its assets minus its liabilities. This method is particularly useful for companies with significant tangible assets, such as asset intensive firms, holding companies, and distressed entities. The core assumption is that the value of the business or investment is tied to the cost to rebuild or replace its assets. The value is derived from the tangible assets owned by the business. Ideal for companies with substantial physical assets or those not generating substantial operational profits. Categories to cost approach. First one is cost to build. The focus here is on the cost to construct the same assets from scratch. Under this, two subdivisions exist. First is net asset valuation. This focuses on calculating the total net asset value. The second is sum of the parts analysis, values individual parts of the businesses and aggregates them. Second is cost to replace. This method evaluates how much it would cost to replace the company's assets at the current market values without necessarily duplicating the exact assets. Then we move on to net asset valuations. It's assets minus liabilities you divide by total number of common shares. The net asset valuation method, also known as the asset-based approach, offers a financial snapshot of the company by focusing on its assets and liabilities rather than its earning. To implement this method, one begins by analyzing the company's balance sheets and financial records to collect all the detailed data on its assets and liabilities. Then these figures are adjusted to reflect their fair market values, updating historical costs to current market conditions. After assigning market values to both assets and the liabilities, the net asset value is calculated by subtracting the total market value of liabilities from the total market value of assets. This approach is particularly very useful in a specific context such as valuing special use properties like libraries or schools, determining the insurable value of property improvements, or assessing over improved or under improved real estate. It also has notable drawbacks. It does not account for a company's past performance or future earning potential. It ignores intangible assets like brand value and goodwill and relies only on the historical cost figures that may not reflect current market value. It also additionally does not consider competitive dynamics or market conditions and can be very challenging to apply in sole proprietorships where personal and business assets can often intertwine. To enhance the accuracy, it is important to adjust book values to current market prices, such as updating the value of land from its historical cost to its present market value. Then we move on to sum of the parts SOTP approach. It is a valuation method primarily used for multidimensional companies, holding companies, or conglomerates. It also involves calculating the value of each individual business unit or division separately and then aggregating these values to determine the total enterprise value. This method is also known as breakup analysis, offers a detailed view of a company's worth by segmenting it into its components part. In the SOTP approach, each division or unit is valued using methods such as discounted cash flow, asset-based valuation, or revenue-based model. The total enterprise value is then computed as the sum of these individual valuations adjusted for net debt, non-operating liabilities, or non-operating assets. Here we have a formula which is expressed as value of segment N1 plus value of segment N2, and then you subtract ND, NL, and then you add on to net assets. This approach is particularly useful in several contexts. It can serve as a powerful negotiating tool in hostile takeovers, demonstrating that the overall value of a business, particularly technology firms with significant intellectual property, may exceed the value of its intangible assets. Additionally, SOTP is valuable in post-restructuring scenarios, providing clarity on the value of each segment after a major organizational change. This approach also has its drawback. It does not account for tax implications that may arise during a spin-off or restructuring, which can significantly affect the final valuation. Then we move on to market approach. Market approach is a valuation method that determines the value of a business, intangible asset, ownership interest, or security by comparing it to recent transactions or comparable assets in the marketplace. It's highly dependent on the availability of the market data and the relevance of comparable transaction. It works on the principle that similar assets should have similar values, and those values can be adjusted based on various factors such as size, location, and specific qualities of the assets. The approach has very key features. The value is determined by comparing similar assets that have been sold recently. It relies on actual market transactions, making it less subjective than some other valuation methods. Factors like size, quantity, timing, and geographical location can be adjusted to make the comparison more accurate. This applications of this approach is used for following purpose: stock market investments. When investing in the stock market, investors often compare recent stock prices of similar companies to determine the fair value. Business acquisition. This method is especially useful when evaluating a business for sale or investment purpose, by comparing it to similar business that have been sold. There are types of market approach. First is comparable asset method. This technique involves identifying and analyzing the sale of comparable business or assets to determine the value of a target business. Second is precedent transactions method. This method uses the prices of recent comparable transactions to value a business, often in the same industry or sector. Then we move on to comparable public company CPC method. It is a relative valuation approach that values a business by comparing it to publicly traded companies within the same industry. It uses financial metrics like price to earning, enterprise value to sales, and other ratios to estimate a company's value. It provides a market driven benchmark. Its accuracy depends on finding similar companies, which can be very challenging due to differentiations in size, operations, and market conditions between both the companies. Despite its limitation, the CPC method is very useful in assessing a company's value, especially when combined with other approaches like precedent and transactions or discounted cash flow. Precedent and transactions method, also known as the price of recent investment method, it values a business by analyzing price multiplies from recent comparable transactions within the same industry. By examining metrics like enterprise value, EBITDA, or price earning ratios, it uses the price paid in past transactions to estimate the value of a similar company. This method works best when applied soon after the transaction, as market conditions can shift over time. It's commonly used in mergers and acquisitions and private equity. Its limitations include time sensitivity, market volatility, and challenges in finding comparable data. Though effective in sectors with active M&A markets like technology and healthcare, its reliability decreases when comparable transactions are rare or market conditions change significantly. Then we move on to income approach. Income approach is used for valuing a business at the present current value of its future earnings cash flow. This approach calculates the net operating income of business and divides it by capitalizing rate. Applications of the income approach, it's very ideal for established and profitable businesses as it is based on the ability of the business to generate future economic benefits. It is also suited for companies with stable cash flow earnings, especially using the capitalization of earning techniques. It's very suitable for appraising real estate to determine its selling price in the current market conditions while investing. The potential risk of repayment is also calculated in case an investor is taking out a mortgage on the investment. Factors to keep in mind while using this income approach is it does not rely on any similar transactions from the past, and it is therefore most effective as compared to market approach. Inputs related to the growth rate as well as required rate of return need to be appropriate as the valuation is very sensitive to its estimation. Especially for a real estate business, the condition of the property needs to be considered. If the property comes with a great number of repairs, this might cut into future profits. At the same time, the operational efficiency needs to be considered, which means rent should be higher than the expenses required to maintain the property. While liquidation value is considered
One
over
question has come up. Sushan, 1 minute. One
Yeah.
question is that a company declared bankrupt on the paper undergoing CRP process has significant assets in terms of land bank, which is ignored under NCLT. How can one determine the value of the land bank assets and use it as a mode of repayment for the financial creditors?
I think Devang Bhai is, I think can take this question. Say,
In case the value, the liquidation value and other things will be considered, and the market value of the land will be considered while doing a valuation, which will be supported by an additional value of a land and building valuer.
So, the person who has asked this question, Vinay, just want to know why do you say that the value of land was ignored? Because that ideally wouldn't happen.
No, it wouldn't have been ignored.
Correct. So I don't know why has that question come up.
The best thing for the person to do is get a land and building valuer to have a separate assessment and take it as a benchmark in the overall valuation of overall valuation of the company, because that only a security and financial asset value can do it.
Correct. So in short, Devang Bhai, just for everyone's benefit, if land's value is not ignored, it will be valued by the subject expert and it will be forming a part of the total value in case of a CIRP process also.
Something which is not in the domain of us or something is better to get a additional opinion done and take that as a benchmark.
Vinay, I don't think so. That should matter because the CIRP process is ongoing. Now, when a CIRP process is ongoing, there are three category of valuers currently in India: securities, financial assets, land and building, plant and machinery. Assume that there is a steel industry which is going through this kind of a situation. Securities and financial assets person will be taking care of certain set of assets. A plant and machinery value will be taking care of certain set of assets, and similar with the land and building. And this is not when only the liquidation happens. Even when there is an active buyer being searched by the CIRP, this building, the land is always valued. So then we can always take it up later. But for the benefit of everyone, this is the land value is not ignored.
So if there's an encroachment or something, that other value or lesser value can be considered. So it depends on the case to case basis.
But it cannot be ignored.
It cannot be ignored. But depending on the circumstances, certain things can be taken, but it cannot be ignored.
Right. Yeah. Please go ahead.
All right. Now here we will discuss few reasons as to why liquidation value is considered over residual value, especially in valuation of financial assets. First is IBC mandate. The IBC requires calculating the liquidation value of assets during IBC insolvency resolution to provide a baseline for creditors. Second is resolution plan assurance. The plan must ensure that creditors receive at least the liquidation value, guaranteeing that they are not worse off than in liquidation scenario. Third is liquidation value definition. Represents the estimated value of assets sold in a distress scenario, typically lower than the market value due to time constraints and urgency. Fourth is purpose of liquidation value. It provides a realistic estimate of creditor recovery. It of assets sold under forced conditions during insolvency or bankruptcy. Residual value refers to the value of an asset at the end of its useful life or after depreciation, typically relevant for continued operations, not for liquidation. Irrelevance of residual value in insolvency. Since insolvency often leads to asset liquidation under pressure, residual value assumptions about continued use become irrelevant. Certainty of liquidation value. Liquidation value offers certainty as it reflects what can be recovered immediately, unlike residual value, which involves subjective estimates and future projections. There are key differences between liquidation value and residual value. First, we can look at the definition. A liquidation value of an asset when sold in a distressed forced sale scenario. Definition of residual value goes as estimated value of an asset at the end of its useful life. Scenario for liquidation value used in insolvency, bankruptcy, and distress assets. For residual value, it assumes ongoing business and long-term asset usage. Time frame for liquidation value is immediate or a short-term sale. For residual value, it's long-term at the end of its asset's life cycle. Purpose is like recovery for creditors and liquidation. Purpose of residual value is depreciation accounting, future projections of asset usage. Applications of liquidation value, it can be applied in realized insolvency or liquidation scenarios, whereas residual value applicable in regular business accounting. Assumptions of operation. Liquidation value assumes business is no longer viable. Assets are sold off quickly. Residual value assumes a business or asset will remain operational. Risk factor in liquidation value, it reflects risk and urgency of selling assets under distress condition. Residual value, less risk considered, assumes steady use until disposal. Now here we can start with case laws. The first case law is what we have is SR Steel insolvency case. And I'll give a brief background of the case. It's one of the landmark insolvency cases under IBC. SR Steel was admitted into resolution process in 2017. SR Steel had substantial financial assets, including operational assets and debt-related instruments. The primary challenge was determining the value of operational assets, especially since the steel plant was running at a very loss but had significant market potential. Valuing the debt owned by SR was also contentious, as different creditor groups had varying perspectives on the realizable value. Two independent registered valuers were appointed to estimate SR Steel's enterprise value using a mix of income-based, discounted cash flow, and market-based approach. The difference in valuation results led to further analysis by the creditors committee. The outcome was ArcelorMittal's bid of 42,000 crore was finally accepted, higher than initial valuations, reflecting a very premium based on future cash flow projections. The case emphasized the need for flexibility in valuation and highlighted the role of competitive bidding in determining the final asset value. We'll move on to the next case law. That is Jet
Sushant,
Air.
Sushant,
Yes.
Akshatji, I think you are involved in SR as your client. So can you just give any input on this particular case, if you can?
So, actually, I have a very old association with SR. In fact, when SR Steel insolvency was happening, so my father has worked with SR Steel for almost 22 years, 20 years.
Oh,
So when the CIRP process was happening, I was, my father was a part of, the whole process. He was, in fact, appointed as a CFO by the COC at that point in time. So I think to just give a perspective, I think what IBC could possibly do with SR. So I haven't been really involved in the CIRP process with as SR as being a client. I don't do any of that work with them. But SR Steel, just out of personal experience, I can say is that I think it was a landmark judgment, as Sushant rightly mentioned, and there was a lot of there was a in a way a precedent set by the regulators that a company with such high debt cannot continue to leverage themselves at the cost of the bank's money. I think it was never expected that as such a big setup that they will actually have to go through the process, and ArcelorMittal pushed in every manner to acquire this, including paying off some 7,000 odd crore rupees to qualify for this bid. So I think that the 2 cents I can share very generalistic it would be that this is something if anyone wants to make a career out of valuation or even insolvency, they have to read this judgment as a Bible. So that's my 2 cents.
okay. Thank you, Akshatji. Sushant, please go ahead.
Yes. So second here we have is Jet Airways insolvency case. The background goes as Jet Airways, once one of the India's largest airlines, entered insolvency proceedings in 2019. We all know that due to mounting debts and operational losses. Its key assets including its brand, airport slots, and aircraft leases. Valuing intangible assets like the brand value and airport slots proved complex as they were non-intangible and market conditions post-COVID were uncertain. Furthermore, Jet Airways' fleet was largely leased, meaning the aircraft themselves were not owned assets, reducing the value contribution. The valuers employed a market approach to assess the worth of tangible assets like real estate and a discounted cash flow model to estimate the value of the brand. Airports loss was subject to regulatory decisions, which complicated the valuation process. The outcome of this case law is it's that the final resolution plan saw the Carl Rock Jalan consortium acquiring Jet Airways for around 1,200 crore, a figure influenced by uncertainty in asset value, especially intangible assets. The case highlighted the difficulty in valuing intangible assets and the importance of market conditions in final bids.
It's
The
still pending in the
panelist,
Supreme Court.
Devang bhai, would you like to
Yeah, this matter is
say
still pending in the higher courts. It's not
Acha.
yet solved.
Mm-hmm. Right. So prima facie, the asset value looks so huge, but
No, all the aircrafts were on either dry lease or wet lease. So there were lots of litigation and by the operational creditors and other things.
when the particular company is in the liquidation or kind of a CIRP, the brand value is substantially eroded. So how, as a valuer, how you determine the brand value?
So not the brand value, that's substantially eroded. That's happened in the case of Kingfisher also. The
Okay.
brand value gets substantially eroded. In this case, there were lots of main assets were airport parking rights and other things, and flying rights and other things from the regulatory and other things that had a value because that was not easily coming by.
Okay. Akshat ji, do you have to say something?
Hello?
Yeah, Akshat ji.
Yes, I think you were talking about the part of the brand value part, right?
Right.
That why does brand value get eroded in a CIRP process?
Yeah, it substantially eroded, it looks like. Otherwise, the kind of brand value they must have taken at the time of, when the company is a
Brand
going
value,
concern.
yeah.
And what is their estimated? Because the entire Jet Airways were acquired at just 1,200 crores.
See, so brand value essentially, reflects what? What is brand value? Brand value is an intangible way of valuing a certain asset which has been created due to a presence of a certain brand in the market. Now, when a certain something goes through a CIRP process, now what essentially happens is, see, when there is an acquisition happening, the brand, there is a going concern factor, which, Sushant, as his first slide, he mentioned. Now, what happens is when a normal merger and acquisition is happening, there is no going concern challenge, and the brand continues to be. Now, for example, there is a brand called Beardo, and all of these they got acquired by, Marico, so they continue to enjoy their brand value, and that is how it works. But when there is a CIRP process, there are many factors which come in, which includes, loss of stakeholders' confidence, negative public perception, operational disruptions, customer migration, because then you're not sure. In fact, a lot of vendors also are not sure whether they want to continue doing business with them or not. So I think that kind of a disruption is in its own a very big loss to the company reputationally, which is what I think really makes a big difference in calculating brand value. Because brand value itself is a feel good, is a perception about a certain brand. And when there is a going concern challenge, whether this company will even exist or will it cease to exist in form of liquidation, that puts a question mark on the brand value part. So you know, the impairment of brand value is very normal in a CIRP process, and I think that's the right way to do it also.
Main value for the airport slots and other things were considered, not the brand value in this case.
Correct.
Okay. Sushant, go ahead.
Yeah. So next we have is Videocon Group insolvency case. Videocon Industries, a large conglomerate with business in consumer electronics and oil and gas, was admitted for insolvency in 2018. Financial assets under consideration included investments in oil and gas blocks, which carried potential future earnings but were currently unproductive. Estimating the value of oil and gas blocks presented a challenge due to uncertainty in future market prices for oil. Additionally, financial claims from secured and unsecured creditors made the valuation process very complex. Value is applied here a combination of market based approaches to estimate the value of Videocon's physical assets and projected future cash flows from the oil and gas business. The large variance in asset values reported by different values delayed the resolution process. Outcome is that the Twin Star Technologies Group emerged as the winning bidder with a final offer of 2,962 crores. However, creditors experienced a significant haircut of 95% on their claims, reflecting the difficulty in arriving at a conscious on the true value of the company's assets.
In this case of Videocon, the main issue was the oil blocks were there were in partnership with many other people and the government. So they did not have a direct control over that oil fields or something. That was one of the major problems here.
Yes.
Okay.
All right.
Sushant?
Yeah. Next we have is Hindustan Lever Employees Union versus Hindustan Lever Limited and others. Facts of the case goes as the case involves a merger of two major companies under Companies Act, Hindustan Lever Limited, a subsidiary of the multinational Unilever based in London, and Tata Oil Mills Company Limited. The merger faced opposition from a few nominal shareholders of Tomco, as well as from employees union of both companies and consumer organizations. The objections raised here included statutory violations, procedural irregularities, issues under the MRTP Act 1969, allegations of undervaluation of shares, preferential allotment, failure to safeguard employees' interests, and concerns about the merger being against public interest. Conditions and valuations. Attempts were made to show that the determination of a valuation was vitiated as a chartered accountant to whom the duty was entrusted did not perform its functions objectively and in accordance with the settled financial norms and practice, and his actions were vitiated as he was one of the directors of the Tomco. Comparative figures of the shares of the two companies, then market value, their holding in the market, etc., were placed on demonstrating that the calculation was vitiated. Judgments passed by the Supreme Court. The jurisdiction of the court is sanctioning a claim of merger is not to ascertain with mathematical accuracy if the determination satisfied the arithmetical test. A company code does not exercise an appellate jurisdiction. It exercises a jurisdiction founded on fairness. It is not required to interfere only because the figure arrived at by the valuer was not as better as it would have been in another method would have been adopted. What is imperative is that such determination should not have been contrary to law and that it was not unfair for the shareholders of the company which was being merged. The court's obligation is to be satisfied that valuation was in accordance with the law and it was carried out by an independent body. Here, the High Court appears to be correct in its approach that this test was satisfied as even the chartered accountant who performed this function was a director of Tomco, but he did so as a member of renowned firm of chartered accountants. More than 95% of the shareholders who are the best judge of their interests and are better conversant with market trend agreed to the valuation determined it could not be interfered by courts. Conclusion goes as Hindustan Lever Employees Union versus Hindustan Lever Limited. Contentions raised by the appellant were put down as the scope of court is limited and can only intervene when it is not just and fair. On valuation of shares for exchange ratio, the court found that a well-reputed valuer of a renowned firm of chartered accountants and a director of Strongco determined the rate by combining three well-known methods, namely the net worth method, the market value method, and the earning method, which was widely accepted by majority of the shareholders. Hence, the appeal failed and was dismissed.
Okay. Go ahead.
Second, we have is Ms. Renuka Dattla versus Solvay Pharmaceuticals and others. Facts of the case. According to the terms of settlement, Solvay Pharmaceuticals and Vasant Kumar have agreed to purchase 4.9%, 91% shares held by the petitioners in these two companies, namely Duphar Pharma India Limited and Dufar Interfan Limited. The petitioners had agreed to sell the said shares. The valuer considered three methods of valuation: asset based, earning based, market based. While working out the earning based valuation, the value on the basis of capitalization of past earnings were adopted. The discounted cash flow method, which is the commonly used methodology for future earning based valuation, was eschewed from consideration. Contentions of valuation. The petitioners have objected to valuation that the control premium has not been added. Second, the value of the various brands have not been included in the valuation. Discounted cash flow method has not been adopted, though it is generally accepted method even according to the value. Supreme Court passes judgment saying that Supreme Court held that if parties intended for special treatment of shares, such as adding a control premium, it must have been explicitly mentioned in the terms of settlement. The court cannot impose such terms when they were not specified, as doing so could have affected the parties' agreement. The court found that there is no error in excluding certain drug brands from the valuation, as they were not considered existing assets of DIL based on relevant records. Regarding unreliable data and projections, the court stated that the valuer should have obtained independent data or requested further details if needed. The petitioners did not provide evidence that the discounted cash flow method would have increased the share value. Given discrepancies in projections, the valuer used past earning capitalization, which was considered a fair market evaluation, and no prejudice was shown to the petitioners. Conclusion: in Dr. Ms. Renuka Datla versus Solvay Pharmaceuticals, the contentions raised by the appellant was put down because the valuer approached the question of valuation having due regard to the terms of settlement and applying the standard methods of valuation. The valuation has been considered from all appropriate angles. No case has been made out that any relevant material has been taken into account or relevant material has been issued from consideration by the valuer. Hence, here the appeal was dismissed. We have key insights from the case studies that we just discussed. First is valuation discrepancies. In all these cases, multiple valuation reports were commissioned due to significant variances in the estimated value of assets, underscoring the subjectivity in valuing financial assets under IBC. Second is tangible versus intangible assets. The case demonstrates the challenges in valuing intangible assets like brand value in case of Jet Airways or future cash flows from oil assets in case of Videocon, which carry a higher degree of uncertainty. Third is impact of market conditions. The economic and market conditions significantly influence the valuations and final bids, especially in industries like aviation and oil and gas. Next, we have is outcome for creditors. Valuation plays a very crucial role in determining the extent of recovery, especially for the creditors. Yeah.
Yeah.
These
Thank
are
you,
few.
Sushant. So, Devang bhai, now whatever we discussed, what is your view? And
The Tomco case and
generally,
other things are cases of the 90s and other things. The Videocon, other things are new. This valuation as a independent professional with IBBI coming has evolved. It has been channelized in a much better way. Previously, it was just taken as a science and extension of accounting and finance. Now it's much more elaborated and much wider scope is there. And now we follow the international valuation standard, which is a benchmark or to consider all valuation and other things. Akshat, would you like to add anything further?
No, I think pretty much you covered everything, Devang bhai. But yeah, I mean, from litigation point of view, from a CIRP point of view, I think valuation is playing a very critical role in, in these kind of insolvencies. And with we closely working with the ministries and one second, sorry.
Yeah. Especially in case of financial assets like debts and other things, in a CRP process, giving a value is a challenge to the value also.
right.
You
can't put it at zero. You can't give a value. It's a very
it's
tough
it's very
call.
subjective. It's I mean, best of the valuers when they work together. I mean, when they work on the same assignment, the value can never be same.
Right.
It is so it is all dependent on the kind of experience one carries and what is the way one looks at. So they are subjective. That is why there will be litigation in valuation. However, with the upcoming standards and improvisation in that is only going to give all of us a better direction on this subject, and hopefully we will move to a more regulated framework in valuation.
It's become more regulated and more challenging. It's become more regulated, you can say.
Right.
So, if there is any question from the viewers, welcome. Otherwise, can we?
One question was there about construction finance or construction CRP also.
Okay. So
one which has been stalled is the Radius Adani one, which is already solved. Many in pipelines and other things. It's awaiting approval at the NCLT level.
So Mr. Akshat, your final word of wisdom on the financial valuation?
Sir, I think I'll talk from a perspective of maybe career, that I think there is a lot of opportunity in this area, and I think one can really achieve great heights by the kind of evolution which is happening in this subject. Today, no transaction, no merger, no acquisition can happen without a good valuer empaneled in it. So it's a very small population of professionals, and we are all still learning and working on it. And with registered valuer now, coming up as a concept and now being a specialized degree, I think it has also helped us all in many ways. So I will only encourage professionals to to look at this field, and there is a lot of learning, and it's a very deep subject. So, and overall, I think I'm happy with the way frameworks of IBBI and all the RVOs are supporting in this entire valuation process. So that's it. Very happy to take up any specific questions, but otherwise, this is end from my side.
It's a challenge to us. Each valuation is a different thing and a challenge to us also as a registered valuer.
Right. Right. So, Disha?
Yes, sir, we can close the sessions now.
Right. So, in my closing remark, first of all, I would like to thank Mr. Sushant for your excellent presentation. You really worked hard to make this presentation we can make out. Of course, big thank to Mr. Akshat Jain, Chartered Accountant and Registered Valuer, for giving your complete insight on this subject. And the way we are listening to or the answered by you, it shows your experience and expertise in the subject. Thank you, Akshat ji,
So,
for coming here and sparing your valuable time. On behalf of course, how can I forget Devang? Of course, Devang is my buddy.
It's a
And
part of you.
yes, but I must thank for participating in very lively in this particular webinar. And on behalf of Mehta and Mehta Insolvency and Restructuring LLP, I also thank all the participants of this webinar. On behalf of normally Dipti ma'am is a founder partner of Mehta and Mehta Insolvency and Restructuring LLP, is conducting this webinar, but she has some emergency, so could not present. But I have been given this opportunity to conduct. Thank you everyone for participating, and panelists for being present over here. Thank you very
Thank you.
much.
thank you, sir.
Thank you very much.
Thank you, everyone. Lovely presentation, Sushant. Thank you,
Thank
everyone.
Thank you.
Thank you. Bye.